It's, first of all, thank you everybody who's sticking around, especially following that fascinating session with the Canadian regulators. And it's always great to see the regulators involved, engaged with an emerging space in finance, because they're a very important variable about making any sort of fintech ecosystem to be successful. So today we have a little bit different panel here. We're talking about changes in finance, the rise and impact of distributed global finance, which is pretty much digital assets. And we have a group of fantastic experts here to share their knowledge. So I'm going to start by asking each panel member to give their 2-minute explanation of who they are, what they do, and then we'll dive right in. So we're going to start with Jason here.
So I've spent the last 20 some odd years as being an entrepreneur, and starting in the early 90s, developing some of the very first internet companies, straight through to direct marketing, publishing, media, and online, to developing some of the first e-commerce platforms, specifically in different regions. And today I am the COO of CoinPayments. We have 700,000 clients around the world. We're in 192 countries, and we facilitate strictly crypto payments for merchants and people to buy and sell and trade crypto assets.
Excellent. Thank you. Lisa.
Thank you. My name is Lisa Cheng. I'm the founder of the Vanbex Group. Vanbex started in 2013 to professionalize the framework for how token sales should be functioning. Since then, we've worked on 70 different blockchain companies. In 2016, we were responsible for 20% of all money raised through token sales.
Wow.
I'm also the founder of Ether Party and Vanbex Ventures.
Thank you, Lisa. Chris.
Yeah, my name's Chris Horlacher, a former Big Four auditor at a CA firm, and former CFO of a stock brokerage, and former management consultant to Fortune 500 companies, and now CEO of Equibit Group, and we are building a new blockchain protocol for capital markets.
Excellent. Eugene.
My name is Eugene Konarev. I'm a serial entrepreneur. I've been in various businesses for the last 16 years. My background is in computer science and finance. I'm a founder and a partner with Go Capital. It's a private equity firm that specializes in structured debt products here in Toronto. I'm also on board with Nerds on Site, a mobile technology provider that operates pretty much in every province in Canada. And I am a founder and CEO of CryptoBay. Is a novel, soon to be published e-commerce marketplace that provides distributed tools and features to the e-commerce participants of today. Now, I think it's going to be a very interesting talk today, and I'll give it back to you.
Yeah, excellent. Thank you very much. My name is Andrew Dixon. I'm the founder and publisher of Crowdfund Insider, so we write about this stuff all the time. And just in the past few days, we wrote an article kind of comparing and contrasting more traditional forms of online capital formation. And I want to share a little bit of that. So, and I'm going to look at it from a bit from the U.S. perspective. It's a little bit bigger market. We had the Jobs Act that created 3 different crowdfunding exemptions. Reg D, 506C, Reg A+, Reg CF. We like to name it things to confuse people. Reg CF started in 2016. Since that date, in total, about $100 million has been raised. Under Reg A+, there's been a lot of issuers that have been qualified through the SEC, but there's a report that we published a number of weeks ago stating that $233 million has been raised since that exemption was actionable. Now, Reg D is a little bit different because Reg D has been around for quite some time. It's a huge market. It's $1 trillion market. What they did is they bifurcated it and created Reg D 506B, Reg D 506C. Reg D 506C is effectively accredited crowdfunding, where you could generally solicit. That's SEC lingo for advertising. So you could crowdfund an offering to accredited investors. Even the SEC doesn't really know how much is raised under Reg D. My guess is under Reg D 506C, you're talking about hundreds of millions of dollars for early stage companies. Now let's compare it to digital assets. Depending on which report you're looking at, during 2017, $4 billion in ICOs were raised. $4 billion. January of this year, according to Token Reporter, was the biggest month ever at $1.8 billion raised. So here you kind of have a dichotomy going on where you have the old online capital formation clashing with the new shiny capital formation of tokenized offerings. So I'm going to ask each of our panelists to share some of their perspective, opinion, and insight here. And we're going to start with Eugene, because Eugene is a guy who actually understands these different exemptions. And so let's look at the traditional stuff, the Reg D, Reg A+, Reg CF, the OM exemption, the regulation crowdfunding. These are all really, really easy to do, right?
Well, nothing is easy. When you go into traditional marketplace, you typically have to be worried about regulators, worried about like breaking the laws by every time you're offering, you know, for $500,000, million, $2 million, or $5 million worth of securities or debt securities out there. So if we look at the traditional instruments, if you relate to Regulation A or Regulation D in the United States, you know, the big problem with those, in my opinion, the big problem with those offerings is that they're not liquid. You typically, every time you invest in those, you're restricted under the Rule 144, and that restriction can last between 6 months and 2 years, depends who you are. Once you're restricted, once an investor cannot sell the security after the investment, that acts like as a barrier to invest. A lot of investors would like to invest, and if they don't like the company, or they feel the company is not moving towards the direction that it's supposed to move, they're just going to exit. Now, once you do a private placement, or Reg A, Reg D, or even Reg A+, as you just mentioned, liquidity is not guaranteed. And that's very different if you will compare that with today's tokenized and you know, ICO world, where there's so much interest out there and it's not regulated. Therefore, investor, as soon as the ICO is done, typically will exit very quickly if there is a substantial number of access on the exit, or will take the equity out and will ride the wave. Now, in Canada, we have offering memorandum exemption, which recently has been updated. So, you know, investors now are qualified as non-eligible, eligible, and accredited. And the reason why this, you know, the prime reason why this update happened and new regulation came in place is to provide additional liquidity into the marketplace that needs capital. There are lots of investors out there that would like to invest into private companies. They think that they may develop interesting technology, so there's a major opportunity out there, but they simply can't. Now, you know, once you divide in your investors in 3 different categories, which is non-eligible, and you can only invest 10,000 or up to 10,000 a year, and then eligible, you know, 30,000 to 100,000 a year, and then accredited can do everything else that they previously were able to do. You're not really providing additional liquidity push in this. So the traditional markets, especially for private companies, they lack liquidity. The access needs to be way larger, and that's why innovation brought to the ICO marketplace and tokenization. And once companies understood that we can go out there, and if we have an interesting technology or software and we can tokenize it, by the way, many of them are really confused by the use cases and if it's a utility or not, companies are going out there and doing it. So innovation drives, innovation in blockchain drives innovation in the capital market, and I think it's just going to continue.
Okay, so we're seeing innovation in the capital markets where people are voting with their feet. They're moving away from a more prescriptive, costly, slower method of capital formation to not just something that's new and cool, it's faster, easier. So that's an important point. Now we have several people up here that have raised capital in an ICO, and at least one that's ongoing. And I'm going to start with you, Chris, because you've done an ICO that's ongoing, but you also raised traditional capital from an angel investor. Can you share your experience with us?
Yeah, so in the very early idea stages of the company, we needed to raise some money to build a POC. And you know, that that really, it wasn't necessarily a choice to do to sell a token or to sell equity in the company. At the point, we were basically just 5 guys with an idea and not enough money to implement it. So, since beggars couldn't be choosers and our investor preferred the equity style investment, we created an offering memorandum so that he could enter the company that way. As a blockchain developer with a new protocol, with a mineable coin, typically, that's something that the company would finance by doing just an ICO. But we didn't really have a problem catering to a more traditional financial structure, and certainly it's a strategy that could be used for any blockchain developer. We could go either way. Now, as we proceeded further along the line, awareness was building about the Equibit system. The community was getting bigger. At that point, it became more feasible to do an ICO because there were a lot more people now out in the public who had been following our work, looking at the system, reading the business case, looking at the team, learning about the technology, and starting to get behind us in a big way. And so ICOs are the way for the community to fund the development of the protocol that they will ultimately use. And it's helpful for the developer because they don't have to sell equity in their company and they can still get their project funded.
Did you consider taking venture money?
Not in particular. I mean, we started looking for funding in 2014, and at the time, there just really wasn't a whole lot of venture funding available at that time. They weren't interested in tokens. So, the only kinds of investments that were coming our way would only look at equity at the time. But that has certainly changed, I think, since 2016. Certainly in 2017, right. The VCs have expanded their mandate to go beyond traditional investments like equity or debt or some other, convertible note. And now they are actually buying the tokens in the ICOs.
Lisa, you raised a sizable round. First of all, Lisa was involved with Mastercoin, and for the people who don't know, Mastercoin has been dubbed the first ICO ever, and I think that's true. So she has a long history. I guess if you could be, a couple of years is long, right? But you actually raised $32 million in your own ICO last year, 2 years ago.
So we had a token sale in October of last year for $33 million, largely via SAFT. Yes. So
can you explain the genesis of how that happened and why you decided to raise money for the ICO?
Sure. So it was, Ether Party really came out of our work with Vanbex, and we were at the time paying remote workers on a weekly basis. And it was conceived that we could automate the whole process through a smart contract, and it would be as simple as someone committing some code through GitHub, and if it was approved, then the smart contract would pay them automatically. We began development in 2015 for that platform, and over the last, late 2016, early 2017, we released a beta on the testnet, and we wanted to, acquire users and create some, viral marketing, so we did a token sale.
So that's cool. And now you're helping other people do ICOs, right?
Right. So we've been helping projects do ICOs since 2013, and back then it was not always a token sale. Sometimes they were venture-backed companies, but the way things are right now, it's largely ICOs that we're working with. We're working with 8 at a time. It's usually a 6-month term, and we help with them from anything between smart contract development, marketing, white papers, token economics.
Okay, so if somebody wants to do an ICO, they need to corner you later today, right?
Yes, sure.
Okay, so Jason, Jason, actually his company, he's quite lucky. I'm a little bit jealous here because he bootstrapped his own company, and now he's in a spot where he doesn't really need to raise capital or dilute his equity ownership, but at the same time, you're engaged right now with an ongoing ICO. Can you share that experience? Because you're offshore, it's a little bit different.
Yeah, for sure. So our company is very successful in this space. It's great to be in a space that is disruptive and creative and supporting other people. That a lot of ICOs actually use our platform to accept methods of payments. So in our process, we don't need to raise money. In fact, every day I'm asked to be bought. And somebody's saying, I want to give you 2 or 6 or 8 times your earnings and EBITDAs and everything else, and we actually don't want to sell, and we don't want to go and do an ICO or anything else. But what we have done is we've had people approach us to license our brand and our product. And recently we signed a licensing deal with a partnership between Syscoin, which is another coin that's listed on exchanges. Successful product, has some really interesting features to it. And we licensed it to create a new decentralized marketplace, allowing people to use the new coin for instant payments rather than going through miners or acceptance and things like that. So that product, we found, we were just in Polycon in Bahamas, and $10 million was raised in a day just because somebody said, hey, we have to be a part of your project because you have users, you have a product, you know what you're doing, you're a success. So in other words, it was almost like a bot, like people just wanted to come in and buy the token and participate. But what I found really interesting is most of these people have made so much money already in cryptocurrencies.
The crypto rich, yes.
That they're not necessarily specifically investors that you would say, hey, you have $10,000, how about I take $10,000 from you? These are people who says, how much can I give you? How about $1 million? How about 5? Hey, I want the whole thing. I want 10 million. Hey, you're raising 50. How about I just participate at the 50 million? It's a very different mindset, a different participation, and I think because they're using the crypto space as a method of earning their increase in value, those assets that they're holding are ones that they want to participate in the blockchain market space. They don't want to go and some people say they want to go buy Lambos and boats and stuff, and sure, a little bit of that happens. But what I find most interesting is the people that are making money, earning more value in the crypto space or in the blockchain space, are re-supporting the community. They're the ones that they're the majority of the people that are supporting other blockchain developments. And that's what we found so amazing in Polycon is it wasn't about, hey, how much equity can I have, or what's the percentage of the tokens you're going to issue. It's, you're building an incredible project. I want to be a part of that project.
So that's key. Absolutely key. So let's jump back to when you should be doing an ICO or creating a tokenized offering. Eugene, in your opinion, when does it make sense to issue a token to raise capital?
Well, I actually have a very serious opinion on this, and I'm really against tokenizing something that does not guarantee the utility. So when I look at today's ICOs or ITOs, whatever you call them, majority of them will not bring any utility, in my opinion. It's a way to raise money for the startup. Like majority of them raise money simply using the white paper and a good promotion team for the token sale. A vast majority of those tokens are ERC20 tokens, or the new tokens that Ethereum is structuring right now. So you're not bringing really any innovation, and you're only promising a future utility. And that's something that I'm really strongly opposing. What I like to do, and what I really see as a future of tokenization, is to provide existing software developers an ability to bring capital to their platforms without diluting the ownership. And that's why I like the concept of utility token when you talk about utility versus security. And for the startups and white paper issuers, I think there has to be some sort of solid limit in terms of what you can raise as a utility token. There's a lot of conversation out there, specifically if you know what's happening with SEC. They're giving out subpoenas like hotcakes in the last couple days, and those hotcakes just gonna keep coming simply because they're already announced that any token is a security. So I'm definitely against that type of approach. I think there needs to be a clear distinction between a security token versus utility token. And utility token approach should be taken when the use case or utility of that token is either guaranteed or almost guaranteed. And that probably somehow could be defined. I don't really want to talk about this today. I don't think there's a scope today to talk about it. Now, if you're a software developer and you have a company that has a good platform, it has good use cases, and it's about to go out there and people can start using, I think utility approach is a great approach. because those tokens will provide utility and use cases to whoever bought those tokens. Just common sense. And that way we can also get rid of the security issue, because if tokens can be used very shortly and provide the use cases that are described in the white paper, or black paper, some people call it right now, then it's fine. Now, if it's a startup and we don't know when that utility will be provided, we don't know when the use case will be available to the purchasers of the tokens, I think there has to be an approach of a security potentially, or if we still will allow them to go out to the market as a utility token, there has to be some sort of cap on this, because when somebody's raising $200 million in the ICO and promising a utility token, a utility use, and a year later there is none, I'm worried. So that's my take. I think there should be a utility token and a security token, and there should be some solid regulation to make sure that industry is supported. It doesn't need to be over-regulated, because over-regulating will potentially damage the innovation. And quite honestly, the reason why we're all here is because of this innovation, because of the blockchain, because of the tokens.
Well, I'm going to ask Lisa the same question, because you're working with issuers now. You have 8 in the queue. Did you say that before? You're working with 8?
We work with 8 concurrently. We worked with 70 since yesterday. And just going back to Eugene's comment about whether something should be tokenized or not, I agree not everything should be tokenized. If there's not a solid use case, if they're just trying to raise money via ICO, it's probably not a good idea to give them any money. There are other projects that are real nuggets of innovation, which have really strong teams, really strong technical ideas, and those are the ones that we should be paying attention to. ICOs first began as a method for open source technology, open source software to raise financing, and then it emerged into this vehicle for people to just raise money, buy Lambos or whatever. And we have to kind of bring it back, and whether that's regulation that helps do that, but it's right now the community and also a kind of a social proof or social way of vetting companies, and we take it to Reddit, we'll go online, and we'll call them out. And that's how we do it today, and whether we need regulators to help us with that, that's not determined.
Yeah, Jason, I actually like this line of topic. Does a utility token exist or not? Is it a unicorn?
I have a little bit of a different view. I mean, I come from crowdfunding. I'm on the Fintech advisory board for the National Crowdfunding Association, and I understand that in the early 90s, we went to go get funding for a company called WSN, the World Shopping Network, which is what the internet is today. And if I could use the community to go and raise my validation around the project, like the blockchain is today and like ICOs are doing today, like Kickstarter or Indiegogo uses the community to validate a product, that to me truly is an ICO. It's the initial coin offering, but it's really the initial proof of concept. It's validating that the community, whether it's a blockchain community, it's a community that wants to buy your product or service or technology, it validates that that's a great idea. I'd like to support that. I'll give you one example, Oculus Rift. They came to Canada, they came to Vancouver to raise $2 million. The investors and VCs that we talked to said no. They said, I don't believe that anybody wants this. They went to Kickstarter, and they raised $2 million. 6 months later, they sold for $2 billion. That was because the community of the crowdfunding group all supported the idea, the concept. They demonstrated to the investor community that actually proof of concept makes sense. So yes, blockchain, ICOs, there's a bunch of people that are coming up with white papers and duplicating white papers and going to the market, and some people are even copying exact same symbols and similar symbols and going to promote to people and say, hey, I'm actually this person, and they're not actually that person, they're taking money and stuff. And there is fraud and there is things, but the purpose of the blockchain community is that we actually are the regulators. We're actually the people that participate in the community to help support our own community to say validation is proven, validation isn't. And if I go to whether it's a security or a financial platform, I look at it as most tokens are actually commodities. If somebody decided to buy a shirt or a product or a grain of rice, and they decided to buy that, and they spent $10 million on rice, and they sold that rice down the road because somebody in their community wanted to buy rice. They couldn't sell that rice to somebody who didn't want to buy rice. So I look at it, the token space and the ICO space as the same community. If I want to buy a token, I'm going to buy that token, and if I have a potential of selling that token in an exchange or a marketplace, I have that opportunity, but I can't go sell it to someone who doesn't want to buy that asset. It's a buy and trade and sell of that asset, and control of that asset is managed through a blockchain. So if it's a security token, I agree. Some people go, I have a great idea, I have a great project, I want to raise money, and I want to share that revenue with those people. That's a security as far as I'm concerned. But if it's a product that you're selling, it's a digital product, I'm selling that digital product, and I'm building a community that utility or that commodity is allowed to be traded between each other, that's truly a community that's supporting each other. And that's what the intention of blockchain truly is. So I look at it as not necessarily a utility token or a security. I look at it as a commodity or a security. And the other side is if it's a financial intention to be a financial trade, which is like a barter dollar, if anybody's familiar with barter, it's a community between people that want to buy and sell and trade between each other. So you have a financial side as well. So there's three pieces that are really there. So my opinion.
Yeah.
We're going to send you down to the SEC. Yeah, go ahead, Chris.
I just wanted to echo what was just said there about the community currency. And so, with the advent of cryptocurrencies, now we have this new form of community currency, and with new technology sometimes comes confusion. But if we remember that these are just a private form of money, then it kind of takes a lot of the mystery out of the word blockchain. It's just a new way for us to do a community-based currency. And certainly in Canada and the United States in particular, we've had a very long history of privately created community-managed currencies. You used to be able to just go down the street into St. Lawrence Market and buy your groceries in something called Toronto dollars, which was a community currency created and accepted by all of the St. Lawrence Market vendors. That was around a long time. And there's even examples of the governments, the provincial governments engaging in this. Generations ago, in the depths of the Great Depression, the Albertan government, under the Social Credit Party, introduced their own community currency to help lift Albertans out of the depths of the Depression. So this is not a new phenomenon, it's just a new technology to do what we have always been doing.
And since Visa and MasterCard started from that same thing, Diners Club wasn't originally a restaurant platform to be able to trade value between the members of that community.
Yeah.
So that's the start of Visa MasterCard. So the idea and the concept has to start with an innovation.
And loyalty points. Loyalty points are just an offshoot of the same thing. It's another form of money that certain people have decided that they will accept, and they're certainly well within their rights to take something that is not Canadian dollars.
All right, so Chris, I'm going to ask you another question. You and I had a minute sit down earlier today, and we started talking about jurisdictions and regulatory jurisdictions. This panel is all about being global and creating a global market, because that's what ICOs have evolved to become, at least until recently. What's your spin on the whole concept of jurisdictions? You're based in Canada, but you're open to being anywhere. That makes things easier, right?
Sure, and with this type of technology, as soon as you launch, you're instantaneously global, and so as a global company, you're going to go where you're treated best, and from a regulatory perspective, that's where we're going to get the most clarity and the ability to conduct business the way the company needs to or wants to conduct its business. Canada, with our history of alternative currencies, we should be a fantastic place for this, but because I guess maybe the blinded by technology perhaps, or the new jargon that has emerged with cryptocurrencies like blockchain and hash rate and cryptocurrencies, and perhaps something that I think can be done better in terms of how the regulators here are going to be classifying and regulating these things. So we've talked about the different kinds of tokens, and essentially there's only two kinds of tokens that exist right now. There's the cryptocurrencies themselves, which all emerge from either a proof of work or a proof of stake blockchain, and they are mined. They are commodities that are used to incentivize the infrastructure providers, the miners. That's why the token exists. And then when we move, so that's at the protocol layer. When we move up to the application layer or the smart contracts, then things start getting a little more muddy. So the smart contract is going to generate a token that can represent anything the smart contract wants. And this is where things can very quickly get very confusing. But by and large, we've seen 3 use cases of smart contracts. We've seen loyalty points programs like Kik, and we've also seen software licenses. Many ERC20 tokens are using it as a software license. And then lastly, we're seeing securities being loaded in and tokenized using ERC20 as well. And that's, of course, the domain of the securities regulator. But the previous 3, I don't think they are, because we have very well-defined law already existing in other places that handle those things.
Would you like to mention any other places you think handle it better?
Oh, well, better than Canada?
Yes.
Oh, well, we've been looking quite a bit. I think probably the best announcement in terms of ICO guidance and demonstrating an understanding of the technology, the best one I've seen so far is Germany, where they came out, BaFin put out an announcement, and they very specifically broke down the token categories into those 2 categories. Also the FINMA guidelines that were published, in Switzerland a little while ago, are certainly another very good way of categorizing tokens. We've also seen good announcements from the UK regulator. We've seen announcements from Gibraltar, Liechtenstein. Barbados is certainly opening their doors to crypto companies. Singapore, Hong Kong. We've seen very good announcements, very positive announcements coming from a lot of countries around the world. And when you compare those announcements to the CSA notice that went out last summer, we're seeing the difference between things that provide clarity versus things that generate uncertainty.
All right, that's interesting. Go ahead.
Just to jump in, because of the topic of jurisdiction and where to domicile, we get this question a lot, and there's 2 main countries that we recommend clients go to, and that's Switzerland or Gibraltar. And the main reasons is because, well, Switzerland came out recently with guidelines on here are the different types of tokens that come out, and Gibraltar, namely, also works directly with the project and will actually review your white paper and say whether or not you're a security or utility. Those are the only 2 that are really friendly right now, where you can confidently go to a place and not be regulated as a security if you're not a security.
So why don't they just do that here in Ontario?
Ontario, namely, is very close with SEC. There's a lot of ambiguity and a lot of misinformation that they've been getting on how they should classify tokens, and that's why we're not progressive.
Okay, well, you're based in beautiful Cayman, so tell me, why are you there?
So my opinion is, we're based in Cayman for tax and operational space and a whole bunch of different reasons as far as quality of life and things like that. I've lived there many years on and off, and that's why we're based there. But our actual entity actually operates in Gibraltar, in a new country called Liberland. There's what we want to do is support innovation around the world. So I actually operate in Hong Kong, the UK, Gibraltar, Monaco, Cayman, and a couple other places. And when it comes to an ICO side, or raising money, it doesn't really matter where you're based. It's where you're taking money from. Right, so if I take money,
it can be dicey though.
But if I take money from a Canadian, as an example, ultimately I have to kind of follow the Canadian rules and regulations. So maybe I shouldn't take money
in every single province, right?
Yeah. So I'm an advisor on about 8 ICO projects, but I'm really an advisor to the companies about where they're structured and how they do their stuff, and not necessarily on their specific ICO. And some of them who work within Swiss regulators and Swiss AG, and they specifically just decided, I'm not taking any money from Canada or the US. And they don't need to, right? They pretty much raised their own money in the ways they do, and they don't necessarily want to take the money from those specific spots, which is kind of a shame, because then the people in those markets miss out on that opportunity to participate with that token or that company completely. So I think there should be some adoption to what that opportunity is.
There should be some change. Eugene, I know you have an opinion on this.
I do, because there is a technological solution out there, not just one, but there are solutions out there right now to keep the jurisdictions where you would like to keep them. Like, for example, one of the companies that I'm advising on, Nerds Inside, has a system in place which can limit very accurately the participants of the blockchain marketplace, not just by IP address, but many other features geographically. So in terms of the future of blockchain and crypto space, I think jurisdictional controls will be required once specifically the security tokens will be properly structured and identified by the regulators. And technological solution is there. Now, if you talk about the tokens that runs on Ethereum, by morphing several of the interesting projects such as like Key or Self-Key together with geolocation projects, you can actually keep the jurisdiction as well. It's not as easy because it's all in software, and probably there's a very interesting, innovative ways to kind of break that. But on a hardware level, we know of several projects out there as well that can run the highway, the blockchain highways, within the parameters that you're going to give that particular highway. Now, in terms of today's environment, I agree with the panel that every jurisdiction that you mentioned as the interesting one, specifically Switzerland, is the one that we like as well. We like what's happening in Caribbean as well. They're really striving to bring innovation and blockchain companies into the area. We also, right now, in the process of identifying several countries in Eastern Europe where governments actually shown a lot of interest on properly, in our view, regulating cryptocurrencies and allowing bank access and card access and also exchanges. CryptoBay might participate in a meeting next week with one of the governments, and if it goes well, we're actually going to announce that. So jurisdictional issues are there. They're going to stick with us for a while and for the time being. But again, through tokenization and through programmable solutions, I don't think that's an issue.
So, I mean, I personally think that the solution is to have like a global exemption, but that's unicorns and Xanadu. That's never going to happen. That hope springs eternal, but I think that would be the best, or at least to start to see some jurisdictions to have some bilateral relationships where Singapore and the UK decide to create their own exemption, and then you don't have to go back and forth, because it creates a serious roadblock to potentially very innovative firms looking to create something cool and unique and an interesting investment opportunity, right? I mean, isn't that kind of the goal and the ambition? Am I off base?
Well, I would agree. I mean, I think that's the whole purpose of blockchain, right?
It's the whole purpose of the blockchain, right?
Create a global community that actually regulates itself and supports itself and validates and verifies what actually happened in those transactions. I think the difficulty is there's certain people, certain countries, and certain groups and certain categories that people want to have control. I'm involved in the banking industry, and the banks don't want to give up control. They want to give up the profits.
Yeah, imagine that.
They want to give up the things. So you got regulators and securities groups. You have entire industries wrapped around these things. I mean, even there's some of the guys in the securities departments who are launching new blockchain projects. In essence, they're blockchain clearinghouses, instantly removing entire sectors of markets.
Exactly.
So who wants to support elimination of their job? So that's the other rollback, is you have communities that have to change. It may not be in this generation specifically that you have that adoption globally, because the global change takes a longer than a lifetime to actually create. And it's what we're actually doing today, that we're putting that forward to say, hey, we are a global economy, we are a global group, and we have to adapt and agree something together. So we'll see what that actually happens.
I totally agree with you. I don't want to go down too much far in the rabbit hole, but when you start talking about RegTech and blockchain, that makes it super simple for a regulator to know exactly what's going on anywhere at any point in time. So regulation becomes just, it's simplified. But you're right, the entrenched bureaucracy culture is hard to change. That's going to take some time. But things are changing. And the ICO digital assets marketplace is changing right now. A lot of it's driven by recent actions, regulatory actions, largely in the United States, where the SEC Enforcement Division went in hot and started shotgunning subpoenas all over the place, which is, it'll settle down eventually. Lisa, what are you seeing now for the issuers that you're dealing with? You mentioned to me that most of the money now it's institutional money, right? So what's going on in this new world of fear and FUD?
So in the early days of token sales, the large number of people that were participating were crypto holders that hung out on Reddit and forums that had a few crypto early on, and that was the large majority of people that participated in this. We've seen a shift within the last year now. It's largely institutional money coming in. The Telegram ICO is a great example of how it's almost all
$850 million so far.
Yeah, well, their goal is $1 billion, and they're probably going to get it, and it's all institutional money. And
I heard people were fighting to get into that.
Yeah,
that people could not get into that offer fast enough.
Well, we got in, so.
Except for her,
but,
right?
Yeah, the reason why institutional money is pouring into this is because of easier access to liquidity. Their money isn't tied up for 2 years waiting for the next raise to happen. They just have to wait for their lockup to end, and it could be within 3 months. And they just got to go hit an exchange and liquidate. Not that you want them to dump, but.
Do we want to talk about the rampant pump and dumping? That's a reality of the space. I talked to the VC a couple weeks ago. He said he made 900% last year.
So I'll just cover one on my opinion. There's a regulated exchange called the OTC markets in the U.S. I'm pretty sure that there's hundreds of millions of dollars that are pumped, dumped, raised, liquidated, and the regulators catch some of these people, and many years later they go after them. It's almost an economy in its own. But it's a regulated industry. So what actually is the regulator stopping people to do? There's investors who lose money, millions of dollars. They don't ever get their money back. The regulators get money, but the individual investors don't get their money back. In the blockchain space, we have an industry that it's creating an opportunity for people, and I'm telling you, as many of the same pump and dump people that are in the OTC marketplace are the same people doing the pump and dump side on the stock market side or on the blockchain ICO space. But it's our jobs that are actually to cancel these people out. It's our jobs.
Can you do that effectively? Because you hop on several Telegram channels and figure out who's going to be the next bump and who's going to be the next dump, right?
I can actually tell you several of them for sure.
Yeah.
But there's also the fact is we can't stop it until that's there. But we can put it out there. We can share it with people. And we can tell within our community, let people know. But some of these people are actually playing that pump and dump because the fact is they're playing volatility. But wait a second, I'm pretty sure that that's what the ETFs and the big financial markets and the guys who are funding these programs are doing too. And they're regulated. So if I'm unregulated and I'm investing in an ICO, it gives me the opportunity to participate within that space. And I know that some big hedge fund or financial guy is in it, then I probably will invest in that deal.
Yeah.
So Lisa, where's this all going? Where are we heading? The SEC is busy right now, but that's going to settle down, give it a few months. Everybody will go to litigation, and then they'll settle, and then the dust will clear. So what's next? What's ICO 2.0 or 3.0?
We're going to start seeing a division of different types of tokens. We're going to start seeing regulated securitized token offerings, and then we'll start seeing maybe capped utility token offerings with more stringent controls on, who is behind the project, how are they spending, are they delivering?
Chris, same question. Where are we going?
I think I would tend to agree with Lisa. It seems that whenever an exciting thing emerges that is gaining traction, the regulators immediately move to slow it down and make it smaller or stop its growth as quickly as it is moving. I won't necessarily predict what will happen, but I could just make a statement that based on what we're seeing, I think what would really solve the issue and help also avoid pump and dumps is that to the extent that a nation has something like the accredited investor exemption, they should probably re-examine whether that is doing exactly what they intended it to do, because the law of
accredited investor definition is so wrong and dumb. Don't get me started.
Yeah. No, you're absolutely right. And of course, these are the same governments that say, well, the smaller investors cannot invest in startups. Forget about what degree or business background you have. If you don't have $1 million or more,
they need to be happy with a lottery ticket and a trip to Vegas.
But
right?
yeah, head on down to your casino and throw it all on red.
That's right.